When the stock market gets scary, people flee to the safety of fixed income. Right? That's the whole thing, is that the stock market is scary, it's up and down, and if you want safety, right, there's risk over there. Yes, there's some reward, but there's a lot of risk. And so if you want that safety, that's where you have fixed income, your CDs, bonds, annuities, those types of investments. But is there any real safety there? Or does switching to fixed income means locking in fixed losses? Because here's the thing, fixed income isn't safe. The most common reason people don't invest in equities, in the stock market, as people call it, is that they are risky, right? That you could lose your money. And so they invest some, or in some cases, all of their money in fixed income investments. Again, bonds, CDs, government securities like treasury bills, annuities, those types of things. Because they believe that these investments are safe. But fixed income is not safe. And here are two reasons, right? One, fixed income is not immune to volatility. And that's what most people mean when they talk about risk, right? Is they mean volatility, the ups and downs in the value or the price of your investments. And the value of most fixed income securities is still subject to volatility, just like equities. Now, it's supposed to be a lot less. But 2022 taught us an important lesson, and that is that fixed income investments can lose big time. Here are just the approximate losses that we saw from their peaks in kind of 2020-ish to their valleys, to their lowest lows in 2022 that we saw across the spectrum from short, medium, and long-term bonds, right? Short-term bonds were down 7.7%. Intermediate-term bonds were down 17%, and the value of long-term bonds was down 39%. If you had long-term bonds, a long-term bond fund, you were down 39% at one point. And if you owned a total bond fund, then a portion of that was down 39% at one point, right? And so, some of that value has recovered, right? And as they pay interest throughout that time, that means their total return, right? Their price return and plus their income return was not nearly that bad. But the lived experience of losing that much value, especially in a short amount of time, is still very real. And so are bonds really that safe if you can still lose these huge values that are in a lot of cases more than we saw in equity losses over that same time? And the reason number two why fixed income is not safe, of course, is that fixed income gets absolutely crushed by inflation. They're a terrible hedge against inflation. According to the quantitative analysis of investor behavior, which we've been kind of studying some of the data over the last few weeks here, is that the main bond index, the Bloomberg Barclays Aggregate Bond Index, right? Say that 5 times fast. That bond index has averaged 3.17% over the last 20 years, ending 2023. And in the meantime, inflation has averaged 2.6%. So the real after inflation growth of bonds has been less than 1%. Less than 1% over the last 20 years. So is that safe? Right? Is it safe to have money that's not really even growing? If you're in retirement or close to retirement and you are or are going to have a 4 to 5% distribution rate, how is your money making less than 1% going to sustain that? How is that safe? Fixed income is not safe. And here's the thing, right? Fixed income loses to perfect timing. So let's say that we agree that fixed income is not a good long-term growth strategy. But so maybe you want to pair it with equity investing and a bit of good timing, right? And it's a common strategy that people try is to time the market, right? To stay invested in equities, to get that nice growth, that long-term growth, the big spikes, but to try to pull out before a market crash. And suppose you timed the 2020 crash perfectly. Right, you pulled out January 1, 2020, based on some whispers that you were hearing of this contagious coronavirus on the other side of the world, and you were spot on. Right, the equity markets plummeted, and you were safe and sound in your nice Vanguard total bond fund. And you didn't quite believe that the recovery was real when you heard reports of that. And plus, there was an election coming up, and this and that. And so you stayed in your bonds. You held tight. And you felt justified when just a couple years later in 2022, the equity markets plummeted again and ended the year down and it lost, dozens of percents. And you, in the meantime, still felt safe in your bond funds. Everything seemed to be going well until your bonds began to fall too. Because that's what we saw, right? As interest rates rose, skyrocketed, then the value of all your bonds would have gone down as well. And even if you had perfectly timed and pulled out before the last two bear markets and were in bonds that entire time, here are your real results. We'll put them up on the screen here, and for the YouTube channel, if you're listening to the podcast, you can go to the blog. That's episode 169, so retirementmentorship.com/169. That'll take you to that. There's a couple of charts in here. And so you can see what this has done since 2020. And even with two bear markets, right? Equities versus bonds, real, not just the indexes, actual Vanguard index fund returns that over the last 4.5 years, ending May 31st, if you had invested $100,000 in the Vanguard Total Bond Fund, you would be down to $95,000. You would have lost almost $5,000 over the last 4.5 years in safe fixed income. In the meantime, your Vanguard S&P 500 fund would be up to $175,000. You would have nearly doubled your money in risky equities, even through two bear markets. And you might be saying, well, I didn't do that. I don't time the market. I'm not that dumb. I know not to time the market. So maybe you didn't perfectly time the market. But was 40% of your allocation already in bonds in 2020? Did you have a balanced 60-40 portfolio? Was your money or even part of it in a target date fund, which is going to have a big portion in bonds throughout that time? Because it makes really no difference whether you timed and moved into fixed income at that point or whether you were just in it the whole time, right? Either way, you've lost money since 2020 in this safe investment. And here's the thing, right? It's no better when we look at actual investor behavior. Because again, this quantitative analysis of investor behavior paints an even worse picture when we look at actual behavior, right? Because as we know, there's a difference between investment returns and investor returns, right? We covered that a couple episodes ago. If you didn't listen to that, go back and find that one. But the effect of investor behaviors on equities is stark. We saw that, but it's also no better on fixed income. And again, we'll post a table of the average returns of real fixed income fund investors versus the bond indexes. And so just for the audio audience here, over the last year, it's actually been good because interest rates are up. The bond index is up 5.5%. Investors are only up about 3%. Over the last 20 years, the bond index again is up about 3%. And the average investor is down minus 0.2%. Right? So over every time frame, other than 1 year, the average fixed income investor has lost money investing in fixed income. So not only have their real returns been almost nothing, their actual returns as investors has been negative. They've lost money. And a lot of that is from moving it around, from trying to time things, from pushing money in and out at the wrong times, from trying to get out of a risky, volatile equity market in 2020, only to get into the fixed income market before it plummeted in 2022. Right? There's a lot of reasons for this, but real investors don't do well investing in fixed income. And here's the thing. Fixed income is a fixable problem, right? I don't know what equity sector is going to do the best over the next 3 to 10 years. I don't know which ones are going to outperform. Large cap, small cap, growth value, tech funds, healthcare. No idea, right? I don't know, and neither does anyone else. But we can be supremely confident that becoming a business owner in the best business in the world is going to outperform being a loaner to those same businesses over the next few years. That being an equity investor is going to outperform being a fixed income investor. We can be super confident of that. And my main goal across this whole podcast and in my financial planning practice, right, is to help investors reduce their fixed income exposure and increase their ownership in the best businesses in the world. Becoming a business owner, right? Becoming an equity investor. We've covered that in other episodes. And staying one. Becoming an equity investor and staying one through thick and thin is the best way to increase your returns. Right? It's the best way. And while there's tons of news articles and blog posts and things out there everywhere about which fund to pick and which sector to invest in, what's going to be hot, and is AI the new big thing, whatever. we don't know any of those things. And everything is trying to focus on getting the next hot fund or whatever else. But all we can control is what we can actually control. And one of those things is asset allocation, and the other is our behavior. Those are the two main things we can control. And those are the things, when we get those two things right, that's what's going to generate most of our wealth. And you may be thinking, man, haven't I heard this before? Like, why are you saying the same things over and over and over again? And if you've been listening to this podcast for a while, yes, you should be picking up on some of these same themes. But here's the thing, right? We need to be reminded more often than we need to be taught. And if necessity is the mother of invention, then recessity is the mother of retention, right? Recessity, reciting things often, reciting the same truths over and over again is what gets them to stick. It's what causes us to believe. And we don't act on what we know, we act on what we believe. So if we can help increase your belief in equity ownership, in owning the best business in the world, and in reaping those awesome rolling returns like we saw last week, then we will help build your wealth over time. That is what we're here for. We'll see you next week. Cheers. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits, all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click on the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.